Okay, ladies and gentlemen, let us continue with our next presentation from our guest speaker, Pauline Yong. Pauline Yong is an author, a financial planner, and a columnist. She started her career as an economics lecturer in year 1996. In 2006, she published her first investment book titled I Love Stock, which later became the bestseller in MPH and Popular Bookstore. Later, she published I Love Financial Planning and I Love Rational Investing, respectively. She writes articles for the various magazines and newspapers that include Nanyang Xiangbao, Money Compass, Chita Bella, Personal Money, and Inspire magazine. She received her MBA in Finance from University of Leicester, UK, and her BBA in Finance from York University, Canada. She is also a member of the Certified Financial Planner and the Certified Financial Technicians. Okay, without further ado, let's put our hands together to welcome Pauline Yong to share with us some tips for using the correct calculator with the fundamental and technical analysis.
Hi, good morning, ladies and gentlemen. Thank you, Canada, for inviting me. And my name is Pauline Yong, and I'm the author for I Love Stock. I'm a certified financial planner, and I'm also a certified financial technician. But I consider myself more of a researcher because I do a lot of research work on the financial markets, particularly the historical data. Now, today's presentation is part of my research work because today's topic is about time cycle. And not many people actually know what is time cycle. And I find that this topic is very important. And through today's presentation, you'll be enlightened, I believe, that you are looking at the financial market at a different perspective. And not many people in the world actually, like me, who look at the financial market in such a way. Okay? So, what is time cycle? Okay. Now, according to Gann, this W.D. Gann was a legendary commodity trader. He was a very, very successful commodity trader. He was so successful that most of his trade was about 80 to 90% were winning trades. Okay. Now he was born in the late 19th centuries, and as you can see, he went through the First World War, the Second World War, and also the 1929 financial crisis. So, according to him, he said that everything moves in cycles as a result of the natural law of actions and reactions. And he said that by studying of the past, I have discovered what cycles repeat in the future. In order to be accurate in forecasting the future, you must know the major cycles. Okay. Now, in fact, this is a premise for technical analysis. What it means is that by studying the past historical data, you can actually make a forecast. Now, isn't this what we always wanted to do, to forecast? Because investing in the stock market is full of uncertainties, and we really hate uncertainties. So, after today's presentation, I hope that you will learn something, and then I will teach you my way of doing the analysis, and hopefully that will help you in your investment. Okay? Now, usually when you study the historical data, right, you will look at the longer the data, the better. So in this case, Dow Jones Industrial Average is 100 years of data. Okay, 100 years of data. So when just look at that, so what I normally do is that I pinpoint the historical high and the historical low. Okay, I pinpoint the historical high and historical low, and then I start to divide them. Okay, divide them into to look at the time frame. So, and then we'll try to see if there's any repetition of cycles, because after all, cycles means repetition, right? So, over here, the Dow Jones Industrial Average, you can see that the time zone is actually, I break it up into like about 20 years of difference. So you can see that this 1929 to 1949 is about 20 years. And between these 20 years, it's very volatile. Okay? And then 1949 to 1966, it's a clear bull run. It's quite a clear bull run. And then 66 to 82, it's also volatile or bear trend. So in technical term, it's either bull or bear. So the first phase here is called the bear trend, the bull, the bear, and then bull. And now we are in another 20 years of cycle. Okay? So in layman's term, you may not know what is a bear. Because if you look at 1929, okay, you have a big sharp fall and also a big sharp rise. So that is a lot of opportunities. If you want to make money, you can make a lot of money with this volatile market. So now we are in this situation, in a very volatile time cycle. Okay, and next, I find this chart very interesting. I got it from the Bloomberg. Now this chart relates the U.S. presidential election with the stock market. And then, as you know, the U.S. Presidential election is either the Democrats or the Republicans, right? So the gray area, do you see the gray area? It's not here. Did you see the gray area here? No. But on my slide, I see the gray area. You don't see the gray area. Oh. Okay. Okay, Nixon. Okay, we start with Nixon, the Republican. Okay, I'll tell you who are the Republicans presidents. So Nixon, President Nixon, Reagan, Bush, and Bush again. Okay, so JFK is a Democrat. Okay, so Democratic, Republican, Democratic, Republican, Clinton, Democratic, and Bush, Republican, Obama, Democrats, and then now the Donald Trump is Republican. So alternate, okay? Now then, because you can't see the gray area, so my slide actually show that during the Republicans administration, okay, during the Republicans administration, did you see that there's a circle there? So those are the stock market crash. Okay, financial crisis. So you know that whenever, I don't know whether it's coincidence or whatever, whenever there's a Republicans holding the office, right? The stock market tends to be volatile. Okay, so you can see that Nixon, you have two of them. Beginning of his, because it's 8 years, so 2 years consecutively. So beginning of his presidency election, and then also end of it. Then for Reagan also, okay, in the 80s, and then the Bush also, and then the junior Bush also 2 times. Okay, now we are who? Donald Trump. Okay, so you know that we are 2017 is going to be volatile. Okay, no doubt. Now, the reason why I want to show you the U.S. market is because some of you may have invested in the U.S. stock market. And also because U.S. stock market will affect the sentiments of the rest of the world. So that's why I need to show this to make you aware of this, okay? Now, after showing you that the Dow Jones Industrial Average, now I'm going to show you our KLCI index. And the KLCI index, we only have about 40 years of data, okay, not many. So, because as I told you, when we do the cycle analysis, right, we need to have more data. The more, the better, because you can see the repetition and then you can forecast to the future. But if we have 40 years of data, it's good enough. So So what I'm going to do for this KLCI index is that I'm going to break them up into 10 years, 10 years, 10 years, and then we're going to go inside the 10 years and then we look at the patterns and then see if we can see anything. We are going to do three things, okay? For this section, we're going to do three things. One is that we're going to find the mean price for the KLCI index for each decade. And the mean price. Number two, we're going to look at which are the years that are volatile, okay? So that we can be prepared. And number three, we're going to identify or to forecast into the next financial crisis, okay, which is what you guys want to know, right? Probably you will tell me later. Okay. Now, this one I'll come back to this later. Now, I'm using the 10 years GAN theory, okay, 10 years GAN theory, and I apply that onto the KLCI index. Now, all this research is my original work. You can't find it anywhere else in the world. Okay, not many people actually do this kind of analysis. So, hopefully, with today's presentation, you will gain some insight, and then you look at this financial market in a different perspective, and that may help you in your investment. Okay. Now, we start in the 80s. Okay, 81 to 1990. Our stock market actually started in 1977 with 100, okay? But with this 80s, you can see that the lowest is about 200 and the highest is about 600. So I take the mean plus minus 200, the mean is 400. Is it fair? Okay, fair. Okay, next. 1991 to 2000, and the bottom is about 300, okay, or close to 200, and the top is about close to 2004. Plus and minus, I put the mean at 800. Okay. These four decades, right? 80s, 90s, 0 and 10s, right? These four slides, I'm going to go back and forth, so that you will have a better idea. Okay. So now I just go one shot, browse through. The next one is 2001 to 2010. So the bottom is about 600, and then the top is about 1,006. So the mean is about 1,000. Okay. Now next we come to our 2016. 2016 starts 2011. Okay, until now we have 6 years past. We still have 4 more years. 7, 8, 9, 10. Okay, 4 more years. So I put the mean as in the estimated mean of 1,600 because there are 4 more years to go. So we do not know where is the top and where is the bottom. Okay, so I just put an estimated mean of 1,600, and then we analyze the later we analyze, and then we come back and then we see. Okay, but I suppose this 1,006 should be fair enough. Okay. Now, the first task we have identified the mean. Okay. Now the second task we are going to identify which are the volatile years. Now we go back. Okay. If you look at it, although the mean was 400, but most of the time or most of the years, this KLCI index was below the mean in this 80s. Okay, in this 80s, most of the years it was below 400, and it was only in the last few years that it shot up and then it went up to 600 plus. Okay, now next. And for this decade, most of the time it is above mean, or at least half of the time it is above mean. So this decade is not that bad. Okay? And this one, also, the last few years, 6, 7, 8, 9. Okay, last few years is above the mean. And this we do not know. we analyze those that we know first, okay? Now, what do you see? What do you observe? Which years are the more volatile years? I mean, as in the year ending with, for example, currently we are 2017, right? So we are now at the year ending with 7. Okay? So which years are more volatile? Is it the 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 0? Which years? 7, okay. And what else? What else? Which years? We see another one. Or rather, which years you find it a bit bearish, or we call it the bear years. Which years? Okay, now, if you look at it, the years usually start slow, and then for this 80s, right, it went down in the middle, 85. The GDP in 85 was actually a negative, okay, a negative GDP. And then it went up, all right. So there's a dent, so-called a dent in the GDP figure in the middle of this decade, okay? Now this one, there's a dent, all right, at the end of the decade, all right? This is also a dent in the GDP at the end of the decade. So, what does that mean? It means those years ending with 7, 8, 9, 0, or even 1 and 2, okay? Or at least 7, 8, 9, 0, very, very volatile. That means big rise and sharp fall. Big rise and sharp fall. And the year ending with 1 and 2 are the slow years. Slow. Economy slow. Slow down. Okay? So I give you the figure for the GDP. Okay, look at it. Now, did you see the big sharp fall, right? Happens, this one starts in the 70s. Huh? So the first big sharp fall, this one, is in 1975. Okay, 1975. So this one, the second one, is in 1985. Alright? The next one, 1998. Also a negative GDP. And then 2008, also a negative GDP. And can you tell me the next financial crisis year? So this comes to my third task. Can you tell me? Okay, I repeat. You got to see the repetition first. The psychoanalysis meaning you must spot the repetition and then you make the forecast. What we see here is that 75, 85. So what I see is that 75, 85, one group, 20 years, one group, okay? And 98, 2008, 20 years, another group. So this that we are going to have is another group, actually. It will determine the next 20 years. It will be the next one that we are going to see, it will be another group. Okay, so can you guess what is the number behind the year ending with? Somebody say something. Here. 2? How do you know? Correct. Yes, that's what I also have that same idea. So because you look at it, see, I told you, you guys can tell me the next crisis year. 75, 85. Then the next one is 98, 08. So 5 plus 3 is 8. So 8 plus another 3 will be 1. So the next prices, it could be, okay, because in share investment, we don't talk about 100%, we talk about probability. Okay, there's nothing is 100%. So there's a high probability that the next financial crisis may fall in the year 2021. Okay, based on our looking at the historical data, we make a forecast. Okay, 4 more years. But usually it starts the year before, right? Because you see, 2008, the year before 2007, 98, the year before 1997. Okay, so starting from 2020, you have to be watch out. So does that make sense to you? So it's interesting, right? You look at, you will see that this, the way we look at it is on a different perspective. It's not the normal way of looking at it anymore. Okay? It's from the past historical data, and you forecast into the future. Yeah. 2031, yes. Yes, another category. Okay. Now, if you can see, another thing I want to show you is this. You look at this crash, right? So towards the end of the year, right, you have this crash. Now, and this crash, right, there are 2 types of crash. One is that you have a flash crash. That means you have a sharp fall and then you have a sharp rebound. Okay, that's one type of crash. The other one is that you have a sharp fall and then you rebound, but you rebound in a weaker position and then you prolong. Okay, so you have 2 types. What we see, okay, go back. In the 80s, this was a sharp fall in the 1987. Okay, this is a flash crash, 1986. This is a more prolonged one, okay? This is a flash crash. Now, flash crash, and then you rebound quickly. Within 2 years, you are recovered, the price is recovered, okay? So when your price is recovered, right, you are actually on a better footage, and then you project to the next decade, you are on a higher mean. Okay, so from 400, that's why you move up to 800. Now this one, this crash, right? You have a crash, but the rebound. Look at the rebound. It's not strong enough. The rebound. You cannot even cover the peak. So that's why, because of this weak rebound, the next decade, when you project to the next decade, the first few years was a slow economic slowdown. Okay, and the mean was actually only increased by 200, which was 1,000. So you see the difference? The key is after the crash, how is the rebound? Okay, whether it's a strong rebound or a weak rebound. If it's a strong rebound, it means that the next decade will be a better position. Okay, but if it's a weak one, that means you're going to have a prolonged kind of a economy slowdown. Does that make sense? Okay. Then, so for our current year, 2017, for this year, because as we can see that the U.S. market is at a historical peak, okay, and we always see that whenever you're at historical peak, it's vulnerable to financial crisis. But because we have calculated it's going to be 2021, right? So what I see is that it may have a flash crash, and then it will be a quick rebound, and there will be plenty of investment opportunities during this period. If you can make money, you will have to make money in this kind of a volatile environment. I mean in trading. Okay, for equities, usually for US stocks, right? If I were to see that we are at a historical peak, like for example, the US equities, I have sold all my position now in US equity on the last week. The last time that I sold my US equity was in 2008. That was already too late because when I sold all my position, I made some losses. Okay, so this round I told myself I'm not going to make any more losses. When I see profit, I better take the money and I have to go. Okay, so but for Malaysian market, I don't sell all my portfolios because even during the 2007-2008, I didn't sell my Malaysian portfolio. In fact, I didn't sell, but when the price went down, I kept buying. I was managed to lower cost many blue chip stocks during that time. Okay, so for because you know Malaysia is majority 80% is institutional players. Okay, the market participants are all institutional players. So in terms of volatility, it's less volatile. Unlike the US market, it's very, very volatile. It may drop like 50%. So if you do not sell your equity, then you are in trouble. And also the dividend yields are not good in the US. Malaysia, the dividends yield are better. So even if the price is low, but you can get the dividends. Just like you treat it like you put your money in the FD, right? Okay. So I'm not that worried about our Malaysian market because we have a lot of fund support. So even if it drops, it will be less than 20% in my view. Okay, and it's a lot of buying opportunities. And what I'm worried is that people who are holding a lot of properties on their hand, because what I see is that right now a lot of people have a lot of properties in their hand. It's like they are buying properties. It's like buying stocks. This kind of mentality is different from last time. Last time during the financial crisis 2008 or 1997, the buying properties was not so common. But over in this decade, things have changed. So what my concern is, as a financial planner, I would advise people to watch out their cash flows. Okay, watch out your cash flows. That means I know some of the property prices has gone down like 20-30%. You think it's cheap, but you must work within your means. Okay, work within your means. That means you do not overly committed. Okay, because right now, for those properties that you can rent out, you can still get rental yield. It will be a positive cash flow. But in the later years, maybe when there are a lot of properties, right, your tenant have moved out, and then you may not be able to find another tenant to fill in. Okay, then you may suffer a negative cash flow. So that's the kind of situation that I'm worried. Okay, so have to be careful. So this is our KLCI index, and now this slide. In fact, I'm not very willing to show this. This is my secret. And if you have this information, do not share, because after all, in this financial market, right, it's for those people with less informed people losing money to the well-informed people, investors. So the more information you have, you are in a better position to make more money in the financial market. So you keep this to yourself. Let's see, okay? Now this is the WD-GAN. I use WD-GAN's method to apply onto our KLCI index, and then I have identified that those years, right, ending with 470 are the peak years. 470 are the peak years. You just recall back, okay, for those seniors, I mean not seniors, like seasoned investors, okay, seasoned investors. You just recall back those years that the stock market was boom, was it the year ending with 4, 7, and 0, okay? Then the bottom, okay, the stock market bottom, they are 2, 5, and 8. 2, 5, and 8. These are the bottom years. Bottom years. Now, so some of you may think, okay, since I know this, why don't I buy at 2 and then sell at 4 and then buy at 5 and then sell at 7, right? I have done the calculation, it's not worth it. You know why? If it's on a horizontal trend, you can make money on that if it's a horizontal trend. But we are all in the uptrend. In the long run, it's uptrend. If you sell and then you could buy higher, it's not worth it. Okay, it's better for you to buy and hold. It's more worth it, especially if you have bought those funds. Some of the foreign funds, they can outperform the index a lot. Outperform the index. Okay, I'll show you the slide later. But over here, you can see that these years, 258, 258. You see the 5 is already up there already. Okay, and then 8. Oh, 5 is already up here. Okay, 258. So this 5 is already, because it's a bottom, because after the 5 it's already up. Okay, so consider a bottom. Now 4 is considered peak because it was kind of horizontal, and then when come to 5, and then come to 6 up. Okay. Now this, right? We can also apply into months. How do we do that? You see, this 4, I put it as April, July, October. So within a year, you can see that the price also moves in cycles. Usually, okay, with high probability, not all the time. High probability that you have April, July, October as the peak months or the top months. Okay, high probability. And there's a high probability that February, May, and August are the bottom cycle low for that year. Okay, it's very interesting. If you spend a lot of time into doing, looking at the data, historical data, you see a lot of new things or a lot of information from it. And not many people actually spend time in the historical data. And they are very important actually. Okay? So, now, 7 is another peak. Now this slide, actually I was showing to my, a group of small audience. I wasn't willing to show to a lot of people. I do not know if I were to show what would happen, because this is like a natural law of cycles, right? What W.T. Gan was saying, natural law of cycles. Will it affect the natural law of cycles? Will it be, happen, I mean, in the future, will it be consistent? Because so far it was correct. It was in 2013 that I showed this, and then I said the next top will be 2014, and then the bottom will be 2015. 2014, the highest for KLCI was 1890. That was a peak, 2014. And 2015, there was a sharp fall in the month of August. August. And 1,500. The intraday low was 1,500. Okay, so and then there was a quick rebound. So now we are in the peak. Okay, but anyway, this is about probability. Anything could happen, right? With the foreign funds coming in, I'm also a bit shocked because I look at the fundamentals, it's actually unchanged. It's just a technical breakout. Okay, for those of you who do the technical analysis, right? The recent sharp bull run was because of a technical breakout. Okay. Yeah. Yes. You can see my Facebook actually. Every week I post the KLCI index, and I have already identified that technical breakout. I think 2 weeks ago. Yeah. Okay. Now this is another way of looking at doing the forecast. This is the W.T. Gan's way. So he said, if you want to forecast, because everybody asked him, right, how come you are so accurate in doing the forecast? So he said, very simple. You just put all the year ending with the same number, right? Put them together, and then you see their trend. Okay. So he said that if you are looking at 1, then you have to put 1981, 1991, 2001, and 2011. Put them together and then see the trend. So that's why 2021, we think that it's a possible crisis because 1 is not always a good year. Okay. Then 2 is also volatile, right? 2 is also volatile. Except 2012, it was a positive year for 2012. The rest was not volatile. Okay. Then 3, it was always a bullish year for 3. Amazing. We didn't know unless we put the things together and then we realized, oh, 3 is a positive year. Most of the time, at least it was true for the past 4 decades. At least it was true. But not necessarily mean that the next decade it may be true, but we are just saying that there's a high probability that it may be like that too in the next decade. Then the year ending with 4 is not looking too good as well. Except even 2004 is like a big rise and big fall. It's very volatile. Okay, 4 is not that good. Then 5 is also challenging. In fact, if you look at it, right, the years that you see a clear bull run, not many years. Not many years that you actually see a clear bull run. Okay? That's why people say stock market investing is very difficult or whatever. Stressful, yeah, because you have to time the market and it's not easy to time the market. 86, the year ending with 6. Now, this year ending with 6, right? That's why last year I put on my Facebook, I said it could be a positive year because I looked at the historical data and then it was showing positive for the year ending with 6. But in fact, it was a negative 3% for our KLCI index. So you can see that not always true. But even if it's a negative 3%, it was not a big fall. Although a lot of people saying that 2016 was a bad year. But I was telling them it has to be a positive. But it's not positive, but at least not that bad, minus 3%. Okay. 7, that's a question mark, right? I can't forecast, I can't give the forecast for the 2017, all right? But what I agree with Chan, Chan is not here. I agree with Chan is that the target, right, for this year, my target is 1760. Okay, it could be higher, who knows, right? The foreign funds are coming, but my target is 1760. Okay. Then 7 years is always challenging. Okay, if there's anything happen, it will be challenging. But it also means that for trader, it's a lot of opportunities. It's very, very volatile and it's very, very profitable. Okay. 88. Okay, now this one is year ending with 8, which is next year. Okay, next year, you can see 8 is not too good either. Okay, but 9 is good. Okay, 9 is good. So probably because 8 you have already dropped so much, then 9 you have a positive year. Okay, so this year by year more of a micro. The previous slide that I showed you was decade and decades. So those are the bigger picture. I always like to use a macro perspective into many things. Okay. Many people use technical analysis as day-to-day trading, micro kind of things, right? But I use technical analysis as to look at a bigger picture, look at a bigger picture, longer term rather than short term. From macro perspective, you go down to the smaller perspective. It's easier rather than from small you go big, because from small you are like the frog under the well, you do not know what's going on. Okay, I rather to look at things from the outside. 2020 it might be a challenging year also because of the historical data. Okay. So for KLCI index, okay, our conclusion is that the year ending starting with this 7, 8, 9, 0, and then 1, 2, okay, these few years are the challenging years because especially 7, 8, 9, you can have a sharp rise and a sharp fall and then the rebound. It's the rebound that determines the next decade. Okay, so we have to monitor how the market participants react to news. So, because usually when you have a stock market crash, right, it's because of certain news. And with that news, the market participants react to the news, and then that reaction causes the price to fall or to move up. Okay, what is the extent depends on the investor's emotion, whether you are very, very scared or you are very level-headed. Because for Malaysia, one of the reasons why we are less volatile is because most of the participants, about 80%, are institutional players. So these people, they are not like retail, you know. We are scared and then we just throw. They are more level-headed, so that's why even if there's a fall, you don't see a big fall. Even with a rise, you don't see a big rise. Very cool, okay? Very stable. Unlike the China market, unlike the US market, the China market, 20% institutional, 80% retail investors. So you can see the China market is very, very, very volatile. But if you want to make money, right, you go to the China market. Why? If you are more informed, you make money from the less informed people. Because most of them are less informed, right? Okay. We apply this cycle analysis onto the other financial markets as well. So this is a crude oil. Crude oil, you can see, we also see that you have mostly 20 years of bear, followed by 10 bull years, and then 20 years bear, and then 10 bull years. Now, I'm afraid we are in the bear cycle. The big picture is a bear cycle, but year to year, you may have a sharp rise or sharp fall, sharp rise, sharp fall, okay? But the bigger picture is that it is volatile. Okay, it is volatile. Starting from 2008 onwards, it's volatile until 2028. Okay, it's volatile until 2028. But I believe for this decade, right, the lowest was achieved, the bottom was achieved already. The bottom for this decade has achieved. So now we are moving up. Okay, we are moving up. Now this US dollar index also has its cycle years. This is purely my own research, okay? You can't find it anywhere else in the world. So my own personal view is that I noticed that the US dollar has a 7-year of bull run for the past, this is 40 years of data, okay? 7-year bull run, and then you have a 10-year of bear, 7-year bull, 10-year bear. So now, if we are looking at if history repeats itself, okay, nothing is 100%, okay, I'm just saying if history repeats itself, there's a high probability that the US dollar index will peak in 2018, okay, if history repeats itself. Alright, then you will be wondering, if US dollar, you cannot invest in US dollar, what else, right? Because Euro is also in question because of Brexit and all those things. I'm also searching what kind of currency we can invest. So at the moment, I just keep in ringgit. Okay, because I can't find any better currency. Okay, let's see. Gold is the next chart. Okay, this is the palm oil. The palm oil, we can see that the year ending with 4 and 8 usually are top years. Okay, palm oil, top years, yeah. 2014. Next will be 2018, and then the bottom years are 0 and 6. So last year. In fact, it wasn't last year. The lowest point was 2015. So plus or minus, okay, plus or minus. You do not get exactly. So all these are about probability. So it could be high probability that 2018 will be another peak. But when to buy, right? Within a year, you also have some cycle low for palm oil. I noticed that usually August is the time to buy the palm oil plantation stocks if you call them. Okay. So it's just my observation. Okay, doesn't mean that it will be true. Just my observation, and there's a high probability that this year in August it could be another cycle low year for the palm oil price. Okay. Now this is the gold price. Now gold price, you have 100 years of data here, so it's pretty good data for analysis. 20 years, 30 years, 10 years, 20 years, 10 years. It's not consistent. It's not very consistent. So I cannot really predict whether we are in a bull or bear. Although I write there bear, but because of its not consistency, right? I cannot 100%. Okay. But if I look at the whole world, if everything is like in a chaos, right? Gold is probably the only place, right? Yeah, people will find that gold is a safe place, but we will see. Okay, but my longer range target for gold is actually 1,005. Now it's 1,002, right? So my target is about 1,005. Okay. Now, so today's presentation, I will talk about this time cycle, right? And then I will have to tell you that this time cycle is just giving you like a background picture of the financial market. It's just a background picture. You look at it as a macro kind of thing, okay? So it is something for you to be aware of. And then, but when you select the stocks, you still need to use fundamentals. Okay? You still need to use fundamentals and the technical analysis. So, if you would ask me, use 5 minutes. Okay, use 5 minutes and then you tell me whether this stock is healthy or not. Okay? If I'm given 5 minutes and I have to say whether this stock is healthy, then I have to ask 5 questions. First, is this in the right industry? Second, the gross profit margin. Third, the net tangible asset. Fourth, the average trading volume. And the fifth is the technical chart. Okay. So the first minute, I will quickly look at this stock, the industry. What kind of industry it is? So for example, Air Asia, airline industry. So is this industry competitive? Does this company has a competitive advantage over other competitors? Competitive advantage meaning that this company has a special, unique selling point that can win the rest of the competitors. So for Air Asia, can you tell me what is the competitive advantage? Yeah. Cheap, right? Cost. The cost is the cost advantage. They have a cost advantage. But now, even Malindo airline is also slashing their price. Okay? So it's a very, very competitive, but I'm surprised that they can keep a gross profit margin of 14%. So this is something, it has to be the management. The management is very good. So that's why they can keep the cost so low. And the reason why I focus on the gross profit margin is because in the times of economic recession, right? Companies with high gross margin can sustain better than the company with low gross profit margin, because this gross profit is like after the cost of goods sold. Your sales minus the cost of goods sold, and then that's your gross profit. And with this gross profit, then you minus the rest of your overhead or wages or whatever. Because during the recession, right? Usually, when the recession, company will cut costs. The cut costs, that means they will cut those wages or whatever. So it's only with this high gross profit you can survive in this kind of a recession time. Okay. Then the net tangible asset is also not bad, quite close to the price. Now, then we look at the chart. When I say healthy trading volume, right, what I mean is that I must see the volume bars. Because some of the charts, right, when you just look at the charts, you don't see the volume bars. You just see the volume bars as in 1 here, 1 there, 1 here, 1 there. So certain days you don't even have trading for that particular stock. So those kind of stocks you want to avoid because and you can't use technical analysis on thin trading stocks. It doesn't work. Technical analysis doesn't work on thin trading stocks. It has to be high volume. So this is healthy, and then the trend. Okay, when you say it's a healthy trend, what do you mean? That means from a glance, you must see that it's an upward sloping trend. Okay, so over here, assuming you do not see this part, if let's say you are seeing like that, right? So that's bearish trend. But in end of last year or mid of last year, it has broken out of that bearish trend. Now it's on a bullish trend. Okay. So it is on a bullish trend. Now this is the fund's performance that I wanted to show you, because if you think that investing in stock market is stressful and then you need somebody to do for you, then you can invest in the stocks. The funds, the mutual funds, or they call it the unit trust. Okay, so I've seen some local funds that quite good, performing quite well. For example, this is I'm not advertising for anybody. I'm just use this as in I see that the performance was quite well. It's eSpring, and the performance is actually above the KLCI index. Okay. Well, for local market, this may be good, but for foreign funds, I have seen better. This one is even better. This is based in Hong Kong. It's called the Value Partners. And you can see the performance is always above the Hang Seng index. And even during the financial crisis, right, it has the sharp fall and then it will go up again. Okay, it's always outperform the Hang Seng index. Okay, so these are the funds. What I'm trying to say is that even if you were to buy in whole, right, you select good funds and then you invest for long term, you can still make money from it. Okay. Now, this one is my new book, because usually I seldom do public speaking. Because of in conjunction of my new book, so that's why I'm here to share with you my personal research. And today's personal research are very, very valuable information. I'm sure you can't find it anywhere else in the world, because not many people actually do research on historical data. So, but because I have been publishing books over the last 12 years. The first book was published 12 years ago. That was I Love Stocks. And after that, I published a few books. Now, this is my 4th and my 5th books, okay? And for Chinese book, it's my first Chinese book. Because over the years, I also contributed articles Chinese articles to various media. So I compiled those articles together, and then I discovered, hey, I can publish one Chinese book, okay? And then if you purchase my book today, you can get a voucher, free workshop voucher, investment workshop voucher, And this investment workshop voucher will entitle you to go to my investment workshop on the April 22nd, 9 to 5. And April 22nd is a Saturday, 9 to 5. The venue is you will have to register through the voucher. There's a way for you to register. Then we'll tell you the venue. Okay? So I hope today's session is helpful in your investment. It's a different perspective, I believe. And if you have any questions, you can ask me.
Okay, thank you, Pauline Yong. We would like to open the floor for the Q&A sections. Raise your hand and let's say you have any questions to her.
Yes. My book of what? A little bit. Because I love trading, right? There's this section about WD GAN, the rules of WD GAN. So a little bit on that. Yeah, because time cycle is a huge topic. Yes, haven't. It's a very big topic. What I'm doing today, the research is only very small part of it. Yes.
Any more questions from Ivo? Thank you for Pauline Yong today share a lot of secrets to us.
Any questions?
One question from here? Yeah.
Pauline,
Yes.
regarding the currencies, maybe you can give some comment regarding how about Sing dollar? What would it be?
Where's the reader?
Here,
There.
Sing dollar.
Sing
Because
dollar.
of late it looks interesting.
Because
Just have some insight. Thank you.
Yeah, Sing dollar is if you look at the historical pattern, right? It's all the way upward sloping. That means we are always depreciating against the Sing dollar all the way. Okay. So, okay, let me explain a little bit about the valuation of currency. The valuation of currency is a reflection of the financial status of the country. If the financial status of the country is credible, the rating is high, then the valuation will be high. Okay? If we have a lot of debt, not so credible, our currency would be depreciating. So it's just a reflection of the financial status of that country. So if you think that Singapore is going to be always outperform Malaysia, I think the gap will be higher and higher. Yeah. But at 314, right? Do you think it will depreciate further? I think more or less, because a currency will not depreciate forever. I haven't seen one currency that depreciate all the way down. No, you will depreciate up to a point and then stabilize, and then you will recover. So I think we are at that point already. And we will not depreciate, we will not have a sharp depreciation like last year.
Another question from here.
Yeah, Australian dollar actually is a commodity currency because they have minerals, right? So if commodity, but the strange thing about this is that I find that even though we have weak commodities, right? Amazingly, we have stronger Aussie dollar. So Aussie dollar is actually a little bit beyond my expectation. But I suppose that's because people find that you have a lot of foreign investment coming from China and those. So that's why the demand for Aussie dollar is still there. A lot of foreign investment, especially from China. Okay. So.
Good morning. Good morning, Miss Yong.
Yeah.
What do you think about the renminbi? Do you think it will depreciate further?
For renminbi, I would think that actually, I know it's depreciating against the US dollar, but actually, I'm a bit worried about the China for the next few years because the 2021 that we identified, right, I suspect was from China. So there's a risk. There's a risk there. There's a risk. Okay, because of their because they do not disclose a lot of information. information. They always cover up. So when the real thing actually blew up, it will be like in like a 4th stage of cancer already. So it's a risk, I believe. Maybe for short term, but not for too long term. Okay. Yeah, 20 seconds. Dividends, how to select dividend stock? Yes, how to select dividend stock. Because I believe, like for me, right, I believe the equities are still, especially Singapore and Malaysian equities, because the dividend yields are quite good. So you just treat it as a bank account, a savings account. Like what I did for my Singapore account. I treat the stock market, treat the Singapore stock market as my savings account. I buy shares, dividend shares, and then I just put it, and then let the the dividend I receive the dividend. Okay.
Last question.
Hello, Miss Yong. One more question. What do you think about the Hong Kong market?
Hong Kong market is also related to the China market, very, very volatile. So if anything happens in the US market, it will affect the Hong Kong market also. Because there is very a lot of retail investors. So they can overbought and then oversold. It's very volatile.
So is it currently overbought?
Yeah, I would think so. I think yes.
Okay, thank you.
I think this year, right? You have to watch out for June, May and June, and then also September, August onwards, September, October, until there's a cycle. Yes.
Thank you, Pauline Yong. Okay, give a round of applause to the Pauline.